Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello, and welcome to Forecast Update Live, a new video series from Ever.Ag Insights, where each month we will gather to discuss our dairy market forecast. I'm your host, John Spainhour. We're joined today by Erica Medke, Matt Gould, and Phil Plord. To get us started, let's take a look at how our forecast has changed from last month. Since we last spoke, Class 3 is now at 1739. Last month, the spot average was at 1689, and we got there with whey relatively unchanged and cheese moving higher. The current 2023 forecast for Class 3 is now 1839. Last month, it was 1869, so we've had somewhat of a decrease in our Class 3 forecast. On the Class 4 front, our spot average is now at 1789. Non-fat and butter are both lower. And last month, it was 1854. The current forecast for Class 4 is 2004, which has been adjusted down from 2005. We're going to dig a little bit into our forecast today, and to help us get there, we've got Matt Gould, who's going to take the bear side of the case, as well as Erica Medke, who's going to approach the argument from the bull side of the case. So to kick things off, Erica, why don't you go ahead and give us what the bull side of the story is for this month?
Thanks, John. Really excited to be here with everybody today. So I would say our biggest concern that would take prices higher is milk production, especially here in the United States. So as we look at producer margins right now, the difference between the milk revenue and the cost of feed is under $8 a hundredweight. That generally puts producers in contractionary territory. And as we're seeing slaughter rates increase across the United States, we are starting to see that happen in real time. So in addition to increased slaughter rates, we are seeing additional farm auction notices. Now, I will caveat that by saying that not all of these mean that cows leave the herd across the United States or that milk production immediately contracts. But our models are expecting Q3 milk output in the United States to be negative. So we are anticipating that the United States will have less milk going forward, which even with stable demand means prices have to go higher.
So, Erica, if I follow your argument, you would say the Class 3 price, the current Class 3 price of $17.40 and the current Class 4 price of $17.89 likely have some upside to them in our forecast due to milk production and the potential decrease that comes along with the current low spot prices.
Well, and let me add to that, John, that's the current class price. There's a lot of places around the United States right now that producers are receiving even less than that. So as we've looked at spot milk prices across the country, those negatives are getting translated back into producer pay and to the milk checks. So going forward, that pain today is more than you would expect. And so that contraction is going to come sooner and more severe.
That's a fantastic nuance. And we've heard several people saying that they're expecting to start receiving milk checks that are in the 15 handle. That's something we haven't seen in quite a long time.
It's going to hurt.
Okay, moving on to the bear side of the argument is our resident bear, Matt Gould. Looking forward to hearing your side of the story, Matt.
Yeah, well, I guess to contrast with the focus on supply, we need to talk about demand. And I don't think there's any surprise that we're experiencing some serious demand headwinds. Yeah, I want to start with talking with butter, where we've seen retail prices just skyrocket, with prices to the consumer up by nearly a third, 30%. And of course, economics tells us that if you raise prices, you're going to lower consumption. And we are seeing mid-single-digit declines in total retail sales. Now, that's how things stand today. And as we look forward, I think the demand case becomes even worse. At the end of this month, we're going to see a step down in government benefits, with government payments to help folks afford food decreasing by nearly 1/5, 18%, or the equivalent of $80 per person. So not only do we have price inflation hitting consumers, we also have fewer or less government support available to American consumers, and so you put two and two together, and our customer is being squeezed, and in response to that, we're seeing much lower sales volumes. Now, this isn't something that's going to abate this month or next month. This is a trend that's pretty firmly in place this year. And so if we're looking for terrific retail demand or domestic demand to make up the difference in this market environment, I just don't see that. And then one of the, I guess to shift subjects, one of the things that has been the canary in the coal mine has been high protein whey prices. We saw them take off at the end of 2021. Their run up kind of predated or foreshadowed the increase in broad dairy commodity prices. And where we're sitting today, they are in free fall at the lowest levels in 2 years. And that remains a concern for me. So while we talked about demand, this is more of a kind of a technical indicator for the broader commodity set. But high protein whey products, which gives us kind of a market value of what protein is worth, still are falling in prices. So, on one hand, we have a demand issues domestically, and then on the other hand, if we're trying to say, our typical indicators or leading indicators are giving us a forewarning of what's to come, that forewarning is still lower prices.
Thanks, Matt. So if I hear you correctly, you would say demand here in the US for a lot of our dairy products already not terrible, but not great. And there isn't any reason to believe that that's going to get a whole lot better in the short term. And if we couple that up against Erica's argument of lower milk production, a little bit of loss of demand might offset some of the potential loss of milk production.
Yeah, and I think when you put two and two together, even if you want to be bullish, there's a limit to how bullish you can be. On the other hand, if you want to be bearish and you don't believe Erica's argument that we're going to see a faster than usual supply contraction, there you can be a lot more bearish from where we are today.
Thanks. Well, let's move on over to Phil Plord here. He wanted to comment in here a little bit about milk production versus demand. And I guess I would say the question I would bring to Phil is, Phil, which one is likely to have a more determining factor on milk prices this year? Is it going to be supply, or do you think it's going to be demand?
John, I think we're really wrestling with the answer could be both, but I think it's demand early and supply late, perhaps. We see a really big tug of war on this milk production question. And while we are looking at the deteriorating margins, that's real. And while we're seeing the auction notices, and that's real. And while we know that cost of production for some people is $22 and 15 ain't going to cut it, that's all happening out there. But we're still not 100% sure how fast this all unfolds, because we're saying all that, but we're also seeing spot milk trading at $7 under class routinely in the upper Midwest, which says not only is there enough milk, there is way too much milk at any given point in time. And we're fond of saying it always takes longer than you think to get that milk production out of the system, which is a beautifully true statement, but tremendously imprecise, right? And so I think that the demand story, I think we have enough supply for today, and I think the demand weakness is going to keep us at these lowish, not very exciting price levels for producers for a while. The big if is, do we turn the corner sometime in the second half of the year where that milk supply does go down? So milk supply, I think, is the swing factor, if you want to look at that. I don't really have much hope for demand much in 2023, just given all the forces at work. I think supply is going to dictate the pace, but on any given day, our confidence wavers on, okay, it's going to happen in May, or it's going to happen in October, right? And I think that's, what we're really wrestling with in terms of our analysis of how this thing's going to unfold. Because I could write you a pretty good story about how the supply side strength drags out for another quarter, and then we're all of a sudden saying, well, maybe 2024 is where we see the strength, or maybe it does happen faster, and all of a sudden this summer we feel tight again. So I think demand weakness is sort of established. I think supply is the swing factor.
So we'd say exactly that. We'd say the demand factor on the steady to weak side, but that's probably not going to have much variability in it. Where price movement's going to come from is likely going to come out of the supply and how quickly it contracts.
That's my view. I don't know how the others here feel, but that's kind of the big wrestling match from where I sit.
I want to remind our listeners and watchers that coming out of last year, there was a lot of deferred milk checks. And so while on a cash basis, farms are underwater, it doesn't necessarily mean that the full extent of the pain has been felt, which is to your point, Phil, it takes longer than you think.
We've certainly been in this situation before. Well, this is going to bring me to our one of our last segments here, which is what we refer to as our favorite look. The Ever.Ag Insights team has really done a wonderful job putting this together in terms of trying to look for a bit of a metric in terms of how do differences in corn prices potentially affect the milk price. And the idea would be that generally the higher the corn price, the higher the milk price, because that is increasing the cost at the production level. The lower the corn price, the lower the milk price follows as well. So Phil put together a really great chart here. I encourage everybody to take a look at it. But it essentially says, hey, let's look at where corn prices have been over the course of the last 21 years and look at it to say when corn price is at an average price of X, that generally the milk price is at an average price of Y. And if we look at it right now on the front end side of things, May corn is at 634. And if we look at that in accordance to this chart, that would suggest to us that the average milk price is about 18.28 over the course of the last 21 years. That doesn't mean that's where we have to be this year, but it's suggesting that a corn price in the low sixes to sevens is going to result in an average price of 18.28. And if we look at the December of 2023 corn far out on the curve, that's at 567. So looking for where does $5 between $5 and $6 corn land us, it shows us that class 3 on average is about 17.16. I think that's important because we want to point out that July to D's class 3 right now is at 1940. And the class 4 July to D's is 1985. So again, those are the July to D's averages of those two, and this is an average of where milk prices have been in relation to corn over the years. But I think it's a pretty good gauge for us to look at and at least keep an eye on as we look forward and try to determine what is milk production going to do. Again, if we follow Phil's argument of milk production is probably going to be the bigger determinant of milk prices this year, then I think this is a really neat and interesting way of approaching that argument by saying, hey, here's where corn prices have been, and traditionally that results in a milk price of Y. Okay, that'll do it for this month's Forecast Update Live. Thank you to all of our panelists, and thank you to everyone on the Ever.Ag Insights team for their work on this forecast. And thank you, the viewers, for tuning in. If you don't receive our forecast update and would like to subscribe, please reach out via email at insights@ever.ag. If you like this video, be sure and subscribe to our YouTube channel, give us a thumbs up, and share us with a friend. We'll see you next month for another edition of Forecast Update Live. I'm John Spainhour, and I can't wait to see you next time.